Hello and welcome back to the Deep Dive. It is Saturday, January 24th, 2026. If you've been watching the financial news this week, you probably feel, well, like you're watching two completely different movies playing on a split screen.
Oh, absolutely.
On one side, you have this tech rally that feels like the future is arriving tomorrow, and on the other, you have sophisticated investors digging bunkers and buying gold.
It really is a massive identity crisis for the market. I mean, I have rarely seen capital split so aggressively into two opposing camps. It's not just risk on or risk off.
It's both.
It's both happening at the exact same time.
Right, a total tug of war.
Yeah.
So we're diving into the vivimoneyDaily report today to try and figure out who is actually winning this game. Because the headline is confusing. Inflation is cooling.
Which should be great news.
Should be. But risk is rising fast.
Yeah, and we need to be really clear about what risk means here. It isn't just the usual, stock prices might wiggle down 1% kind of fear. It's structural. The report talks about something it calls liquidity memory from late 2025, combined with a move in precious metals, that is. Frankly, it's historic.
Liquidity memory. That sounds like a sci-fi concept, but I have a feeling it impacts our portfolios directly. So here's the mission for this deep dive. We're going to decode these mixed signals.
A lot of mixed signals.
We have Bitcoin flushing out leverage, gold is knocking on the door of $5,000, and the Fed is stuck in this political storm. We need to figure out what this all actually means for your strategy right now.
It's a messy picture, I won't lie. But to see it clearly, we have to start with the engine room of the global economy. The macro environment.
Let's do it. So looking at the dashboard, the headline numbers for the 10-year U.S. Treasury yield are, well, they're stubborn.
Very stubborn.
We're seeing it just bouncing around in this high range between 4.15% and 4.32% and just refuses to drop. Why does that specific number matter so much?
Because that yield is the risk-free rate. It's the hurdle that every other investment has to jump over.
Okay.
Think of the 10-year yield as gravity. It's gravity acting on the stock market. And specifically, it pulls down the valuations of high-growth tech stocks.
So if you can get a guaranteed return.
Exactly. If I can get over 4% guaranteed from the government, why should I take a big risk on a startup? So as long as rates stay trapped in that 4.15% to 4.30% corridor, there is a distinct speed limit on how fast the NASDAQ can run. It puts a hard ceiling on the excitement.
But here's what I don't get. The narrative for the last 6 months has been inflation is cooling.
Right.
The core CPI and PCE data, the stuff the Fed actually cares about, is all showing a downward trend. In a rational world, shouldn't that mean rates come down?
Logically, yes. If you were running a strict economic simulation, rates would drop. And the market is betting on rate cuts because of that cooling inflation.
Right.
But we aren't in a simulation. We're in an election year cycle with a massive amount of noise. The report highlights significant political and judicial uncertainty surrounding the Federal Reserve right now.
Right, the Fed likes to pretend it operates in a vacuum, completely independent of Washington, but...
It doesn't. Never. And the market hates uncertainty way more than it hates bad news.
That's a great point.
With bad news, you can price it in. You can do the math. With uncertainty, especially about the central bank's independence or, the timeline of their decisions because of court cases or politics, you can't model it. That political cloud makes traders nervous. They don't want to commit to the idea that cheap money is coming back soon.
They're waiting for the other shoe to drop.
Exactly.
Speaking of which, I want to drill down into that liquidity ghost you mentioned. There was a specific item in the source material that it really caught my eye. It's about the New York Fed's facilities on New Year's Eve, December 31st, 2025. It sounds technical, but the report treats it like a smoking gun.
It is the most important data point that nobody is talking about on the nightly news. It's the plumbing of the financial system creaking.
Okay, so walk us through it. On New Year's Eve, the Standing Repo Facility, the SRF, loaned out about $74.6 billion. At the same time, the Overnight Reverse Repo, the on-and RRP, took in about $106 billion. Those are massive numbers, but what do they actually mean?
Okay, let's simplify this. Imagine the financial markets are a massive plumbing system. Cash is the water.
Got it.
On December 31st, the pressure in the pipes got incredibly high because banks needed cash, like desperately, to balance their books for year-end. They were so short on cash they had to sprint to the Fed's emergency window, that's the SRF, just to get liquidity.
So they basically had to pawn their assets to the Fed to get cash for the night?
Essentially, yes. It's like running to a pawn shop on New Year's Eve because your ATM card stopped working.
Yeah.
And even though everyone waves it away as a seasonal technical adjustment,
It's just a year-end thing.
the sheer size of it, nearly $75 billion left to bruise, it signaled that underneath the calm surface of the stock market, the actual plumbing is rusty. Short-term liquidity is tight.
So it's like a car engine that runs fine at 30 miles per hour, but if you floor it, it starts shaking.
Precisely. It tells the big institutional players that if a sudden shock hits, a geopolitical crisis, a bank failure, a surprise election result, there might not be enough grease in the gears to keep things moving.
Ah.
That memory of liquidity stress is keeping the smart money very, very cautious, even while they're buying stocks. They know the exit door is narrow.
And meanwhile, the labor market is just kind of chugging along. We aren't seeing mass layoffs, are we?
Oh, December, non-farm payrolls were plus 50,000 jobs. Unemployment is at 4.4%, which is fine.
Just fine.
The definition of a soft landing so far. We've moved from that super hot, overheated market of a few years ago to just a normal one. We aren't in a recession, but the engine is definitely throttled down.
So it supports rate cuts but doesn't demand them.
Exactly. It's basically Goldilocks, but with a lot of wolves waiting in the forest.
Okay, so the engine's running, but the plumbing is creaky and the wolves are circling. Let me talk about where the money is running to hide. Segment 2. The defensive rush. Honestly, this was the jaw-dropper of the week for me.
It's the story of the year so far.
Gold! Spot gold hit a record high this week, catching approximately $4,976 per ounce. I mean, we are knocking on the door of $5,000 gold. And silver broke the $100 barrier.
It's incredible.
5 years ago, if you told someone gold would be $5,000, they would have called you a doomsday prepper.
And now it's just the reality. But you have to ask yourself, why now? Stocks are near highs. Usually people buy gold when stocks crash. They buy it when the world is ending. The S&P 500 is doing okay, so why is everyone buying doomsday rocks?
Exactly. Is it just inflation?
It's not just inflation hedging anymore. This is institutional fear. The report points to the VIX index, the fear index.
Right.
It spiked near 20 recently.
Yeah.
That means the cost of buying insurance on your portfolio is getting expensive. The big players are paying a premium to protect themselves.
And we see it in the currency markets too, right?
Correct. The US dollar index, the DXY, is wobbling between 97 and 99. The dollar is looking shaky amidst all the geopolitical tensions we're seeing. And when the dollar weakens and global anxiety rises, money doesn't go to Bitcoin, not immediately anyway. It doesn't go to real estate. It flees to the hardest asset with a 5,000-year track record.
So what does this actually look like for a big hedge fund manager? Are they selling everything?
No. And that's the barbell concept we'll get to. It means they are hedging their bets aggressively. They are buying insurance gold with one hand.
And playing the casino with the other.
Exactly. Playing the casino tech stocks with the other. It creates this very dangerous but potentially profitable environment. They are terrified and greedy at the same time.
Terrified and greedy, that sounds like a stressful way to live. But let's look at the greedy side. Segment 3, the offensive play. We know they're buying gold to sleep at night, but what are they buying to make money during the day?
Well, if you look at the broad market, the S&P 500, the VOO, it's actually pretty boring right now. Yeah, it's trading with thin volume. It's consolidating. It's in wait-and-see mode. The NASDAQ 100, QQQM, is hovering around 256, 257.7 months. But if you look under the hood...
Let me guess. It's the AI narrative again. It always comes back to AI.
It does, but notice how concentrated it's becoming. It's not everything goes up anymore. It's a very select club.
The source material highlights NVIDIA specifically. They remain the core of the infrastructure trade. It feels like the entire market is obsessed with their corporate purchasing rhythms.
NVIDIA is the heartbeat. Look, the thesis is simple. Are Microsoft, Amazon, and Google still buying chips? If yes, the trade is on. If they stop, the whole trade unravels. But for now, that's where the offense money is flowing. They're betting that the infrastructure build-out isn't over.
What about Tesla? They seem detached from the rest of the Magnificent Seven sometimes.
Tesla is trading on its own internal rhythm right now. It's driven by product releases. It's less about the macro economy and more about what are they shipping next. It's a very specific bet on execution, not just AI in general.
Then you have Meta and Google. There seems to be a bit of a disagreement there on valuations in the report.
That's the tension between massive AI spending, CapEx, and the health of the advertising market.
Okay.
Investors are asking a really tough question. You're spending billions on AI data centers, but is your core ad business healthy enough to pay for it? That's causing some friction. If the ad market softens, those AI bills are going to look very, very heavy.
So the take here is that the offense strategy is basically pick the winners because the tide isn't lifting all boats anymore.
Extremely concentrated. If you aren't in these specific names, NVDA, the semis, the AI giants, you likely aren't seeing the gains. But here's the catch. Because everyone is crowded into the same lifeboat, the volatility is extreme.
Right.
Any piece of geopolitical news sends these stocks whipping around because everyone tries to exit once. It's a crowded theater with a small exit.
Speaking of crowded theaters and whipping around, let's talk crypto, segment 4. This feels like a bit of a reality check after the run we've had.
I'd argue it's a healthy reality check, but it definitely hurts if you bought the top.
Let's look at the damage. Bitcoin has pulled back from its highs. It's trading between $89,000 now and $90,000. Ethereum is tracing it, sitting around, what, $2,950 to $3,050?
Yep.
And Solana, well, Solana is just being Solana, high volatility, trading around $130 to $140.
The key metric here isn't just price, it's sentiment. The crypto fear and greed index dropped from greed all the way down to caution neutral.
Is that bad? Usually you want greed because that means prices are going up.
In the short term, greed is fun, but it's unsustainable. The report calls this drop a leverage flush, and that is actually a good thing for the long-term health of the market.
Okay, let's unpack that term for the listener who isn't a day trader. What is a leverage flush?
Imagine a poker game where everyone is borrowing money to bet. The pot gets huge, but nobody actually has the cash. They're all playing on credit. Eventually, the dealer calls in the loans. When Bitcoin dipped slightly, it triggered a chain reaction of margin calls. People betting with borrowed money got automatically sold out by their exchanges.
Oh, wow.
That forced selling drives the price down further, which triggers more selling.
So the weak hands got shook out, the gamblers got evicted?
Exactly. It clears the deck, it wipes out the excessive exuberance. Now, the market is cleaner, but it needs to find a floor. The report suggests the key resistance level to watch is that $95,000 to $98,000 range.
Okay.
If we can break back above that, the bull run might resume. But until then, we're in the penalty box.
And it's not just the coins, right? The crypto-adjacent stocks like Coinbase and Robinhood are going for a ride, too.
They are whipping around violently.
Yeah.
When you have a leverage flush in crypto, the exchanges that rely on trading volume and asset prices, they feel the shockwave immediately. If you own Coin or Hood, you need a strong stomach right now.
Okay, moving on to something I found really intriguing and honestly a bit scary. Segment 5. The frontier. Pre-stocks.
Ah, yes. The secondary markets. This is where the FOMO is really hiding.
The source material mentions names we know. Anthropic, XAI, OpenAI. These are the biggest names in AI, but they aren't public companies yet. You can't just go on Robinhood and buy them.
Right.
But people are trading shares of them on the secondary market?
This is the Wild West of finance. These are private shares being traded between accredited investors or through special platforms. It's essentially people trying to buy into the IPO before the IPO happens.
The report lists them as high-risk, small position speculation. Why the strong warning? If these are the companies of the future, shouldn't we be all in?
Because of liquidity or the lack of it.
Yeah.
In the stock market, if you want to sell Apple, it takes a millisecond.
Right.
In the secondary market, if you want to sell your OpenAI shares, you have to find a buyer. The spreads are massive. You might see a price of $100 on one platform and $140 on another.
So you can get trapped. You see a high price, but you can't actually sell for that price.
Easily. It's like the Hotel California. You can check out anytime you like, but you can never leave, at least not quickly or at the price you want. The source material is very clear. This is not for the faint of heart.
Got it.
It's for people who can afford to have that money locked up for years. Or you just keep the position tiny. Treat it like a lottery ticket, not a core investment.
All right, we've covered a lot. Macrogravity holding rates up, gold spiking to $5 on fear, AI concentration, crypto flushing out the gamblers, and the murky world of pre-stocks. Let's bring it all together. Segment 6, strategic takeaways. The report recommends a barbell strategy. What does that look like in practice?
Okay, so this is the actionable synthesis. A barbell strategy just means you are super safe on one side and aggressive on the other, with pretty much nothing in the middle. You're avoiding the lukewarm middle.
Okay, let's build the barbell. Step 1, defense first.
Right. Because of that political uncertainty and the liquidity ghost, your core holdings shouldn't be speculative. They should be boring. Broad ETFs like VOO for the S&P 500 or QQQM for the NASDAQ. That's your foundation. Do not get cute with the rent money.
Step 2, the hedge. And this seems to be the critical update for this week.
It is. We talked about the VIX and the geopolitical risks. You need an allocation to gold, whether that's an ETF or physical bars. You need something that goes up when the system gets scared. It offsets the systemic risk in your tech stocks.
The parachute.
It's your parachute. If stocks crash because of a war or a bank failure, gold is your parachute.
Step 3, the tech play. We still want that AI growth. We can't ignore the future.
You do. You want exposure to the AI giants NVIDIA, Google, but do not buy all at once. The report recommends strict tranching.
Tranching, that's just fancy talk for splitting up your buys, right?
Exactly. Buy a little now. If it dips, buy a little more. Don't throw your whole paycheck in at the top. The volatility is just too high for lump sum betting right now. You need to average your way in.
Okay. Step 4, crypto.
Small positions. Strict stop losses. If you're a long-term believer, dollar cost averaging, DCA, is fine. But if you're trading, be very careful of that leverage flush. Don't get wiped out because you got greedy with margin.
And finally, step 5, cash is king.
Keep some powder dry. Keep cash or short-term bonds ready. Why? Because of that liquidity ghost.
It all comes back to the plumbing.
It does. If we get a liquidity shock, that plumbing problem we talked about, and the market tanks, you want to be the one with cash ready to buy the best assets at a discount. You want to be the buyer when everyone else is forced to sell.
That makes a lot of sense. Be boring with the core, paranoid with the gold, surgical with the tech, and keep some cash for the crash.
A balanced plan for an unbalanced world.
I love that. Okay, we're wrapping up. If we had to summarize the market in one sentence for January 24th, 2026, it would be this. Inflation support implies rate cuts, but liquidity memory and leverage clearing are raising the cost of safety.
That sums it up perfectly. The cost of being safe has gone up, but the cost of being risky is getting unpredictable.
But before we go, I want to leave you all with a thought to chew on. We talked about gold hitting $5,000. We talked about the repo market stress on December 31st.
If you connect those dots, think about it carefully. If the financial plumbing, the SRF and repo markets, was creaking and groaning on New Year's Eve, and now, weeks later, we're seeing the smartest money in the world pushing gold to $5,000. Is the market sniffing out a plumbing problem that the headline stock indexes haven't noticed yet?
Is the gold market seeing a crack in the dam that the stock market is just ignoring? That is the question.
It usually does. Gold is the old man of the room who has seen it all before.
Well, on that cheerful note, check your fear versus greed balance this weekend, everyone. Thanks for listening to the Deep Dive.
Stay safe out there.